What if the ultimate plan to crush China isn't about tariffs, but about revaluing America's entire gold reserve? We've been told the trade war is a stalemate defined by taxes and sanctions, but that is a public illusion. A small but significant faction of economists believes a future administration could weaponize the 8,133.5 metric tons of U.S. gold reserves and the power of decentralized crypto to dismantle Beijing's financial system from within. This isn't just theory. It's a blueprint for economic shock and awe. Do you have a plan to protect your investments when the world's two largest economies launch a financial war using gold and digital currency? For years, a quiet but massive shift has been happening in global finance. Central banks, especially the People's Bank of China, PBOC, have been stacking gold. By late 2025, the PBOC's relentless buying spree had pushed its official gold holdings steadily upward, with reports showing reserves climbing past 2,300 tons. But official numbers don't always tell the whole story. Some speculative theories, popular in certain financial circles, suggest China's true holdings could be multiples of that, maybe even over 5,000 tons, held secretly in different accounts. While those figures are unverified fringe speculation, the trend is undeniable. China is hoarding gold. Why the obsession with this ancient metal? The strategy is clear: de-dollarization. Beijing sees its huge holdings of U.S. debt as a vulnerability. In recent years, China's holdings of U.S. Treasury bonds have fallen from over $1 trillion to figures in the low hundreds of billions. This reliance on the dollar gives Washington immense power. Gold is China's insurance policy, an attempt to build a parallel financial system insulated from American influence. So, in our hypothetical 2025, a Trump administration would need to turn China's shield into a weakness. The secret plan's first move: a gold offensive. The United States officially holds the world's largest gold reserve, a massive 8,133.5 metric tons. For decades, this gold has just sat there, its value on the government's books frozen at a statutory rate of $42.222 per ounce. A relic from the 1970s, but what if Washington changed the rules overnight? This is where the speculative but fascinating idea of a gold revaluation comes in. Popularized by analysts like Luke Grauman and Jim Rickards, the theory suggests the U.S. president could revalue America's gold to its market price or even higher. Imagine the U.S. reprices its gold from $42 an ounce to, say, $12,000. It's not as simple as printing money. It would create accounting gains, not instant cash, and face huge legal and political hurdles. But as an extreme policy tool, the idea exists. It even has a loose historical precedent. FDR revalued gold in 1934 to fight the Great Depression, though that was under a completely different monetary system. In this strategy, the revaluation is an attack. It would be a direct challenge to China's narrative that the dollar is a declining, unbacked currency. The second move would be even bolder: creating a gold-backed digital dollar. This isn't your typical CBDC. Picture a digital token from the U.S. Treasury, fully redeemable for physical gold from America's newly revalued reserves. This entirely speculative instrument would be a masterstroke, combining the speed of digital currency with the trust of gold. This one-two punch would put Beijing in a bind. Their gold pile would suddenly look small. Their efforts to promote the yuan would be sideswiped by a new, trusted gold-backed digital dollar. China's financial shield would be cracked, but that's just the first front. The second would be fought on a newer, wilder battlefield: crypto. Is the gold offensive just a rumor, or does the U.S. have the legal authority to revalue its gold and crash the global dollar narrative? China's relationship with crypto is openly hostile. Since 2021, Beijing has cracked down hard, banning crypto mining and trading. The reason is simple: decentralized currencies like Bitcoin threaten the Communist Party's control. They let capital move anonymously across borders, undermining the government's strict controls. Instead of private crypto, China is pushing its digital yuan, the ECNY. This isn't a cryptocurrency, it's a centralized digital currency. While it has practical uses, it also gives the state unprecedented visibility and control over citizens' transactions, leading many to label it a surveillance tool. Our hypothetical 2025 plan would exploit this. The logic is simple: if China fears decentralized crypto, the U.S. should embrace it. The first step would be covert. Imagine U.S. agencies quietly working to promote crypto use inside China, encouraging VPNs to bypass the Great Firewall, funding user-friendly hardware wallets, and even orchestrating airdrops of small amounts of crypto to seed an underground economy. The main weapon wouldn't be Bitcoin but dollar-backed stablecoins. These digital tokens are a frictionless way to access US dollars, bypassing traditional banks. By promoting their use, this theoretical operation could provide an escape valve for Chinese citizens wanting to move wealth out of the yuan. Creating a financial fifth column that puts immense pressure on China's capital controls. The second step would be more overt. While China bans Bitcoin, this hypothetical plan sees Washington officially embrace it. A key move could be creating a strategic Bitcoin reserve. The US government has already seized hundreds of thousands of Bitcoin from criminals. While current policy is generally to auction these assets, a speculative executive order could instead consolidate them under the Treasury, officially adding Bitcoin to the nation's reserve assets alongside gold. This fictional move would grant Bitcoin a new level of legitimacy, positioning it as digital gold. It would create a powerful narrative. The free world embraces decentralized finance, while the authoritarian world fears it. To bolster this, the administration could push for something like the Genius Act, a hypothetical law to make the US the safest place for stablecoins, attracting capital and innovation. This crypto assault covertly fostering a dollarized underground economy in China while overtly legitimizing Bitcoin would create a new financial front, weaponizing decentralization itself. With China's foundations shaken, the stage would be set for the final blow. Is embracing decentralized crypto a brilliant financial weapon, or is it a risk that could backfire on the US government? Tariffs were the signature weapon of the first Trump term. But the theoretical October 2025 deal, where the threat of 100% tariffs was shelved, might have suggested a limit to their power, with China's control over rare earths giving it leverage. But in this secret plan, that deal was never the endgame. It was a strategic pause. A feint. The gold and crypto offensives were designed to neutralize China's leverage first. The logic of this three-front war is brutally simple. The gold offensive shakes international confidence in the yuan. The crypto gambit bleeds the Chinese system from within through capital flight. With Beijing forced to defend its currency and plug capital outflows, its ability to withstand an external trade shock would be crippled. Its leverage would mean little if its own financial house was burning down. This is the moment the plan would call for activating the final phase. Having lulled Beijing into a false sense of security, the administration, in this theoretical scenario, would unilaterally declare the deal void. And then, it would do what it had only threatened, implement a 100% across-the-board tariff on every single product imported from China. This is the economic equivalent of a naval blockade. The American market, the world's largest, would be slammed shut overnight. For China's export-driven economy, the effect would be catastrophic. Chinese manufacturers would see orders vanish. Factories would shut down. Mass unemployment would ripple through the country. Unlike before, China would be in no position to fight back. The tariff coup de grace isn't a negotiating tactic. It's a knockout punch. If a 100% tariff is the final blow, what hidden weaknesses would appear first in China's massive, debt-laden banking system? If this hypothetical plan worked, the outcome could be a full-blown systemic crisis in China. The combination of an unprecedented trade shock and internal financial instability would create a perfect storm. The first cracks would appear in China's massive, debt-laden property and banking sectors. With export revenues gone, corporations would default on their loans, and a banking crisis would become a real possibility. The social contract in China is built on a promise. The party delivers prosperity in exchange for political control. A sudden economic collapse would shatter that contract, and the prospect of social unrest would become the leadership's greatest fear. It is at this moment of maximum weakness that the US would come to the table, not as a peer, but as a victor dictating terms. The demands would be aimed at permanently altering China's economic model. Abandon state-led industrial policies, dismantle capital controls, let the yuan float freely, and open its financial markets completely. The goal wouldn't be a trade deal. It would be the economic equivalent of unconditional surrender. To be clear, what we've just walked through is a speculative, what-if scenario. It's a thought experiment, piecing together real-world trends, speculative theories, and hypothetical strategies. There is no public evidence that such a comprehensive plan was ever formally considered. However, Many of the underlying elements are part of the current geopolitical landscape. The use of tariffs, the de-dollarization push and gold buying by China, and the rise of cryptocurrencies are all very real. But other key parts of this blueprint, like a massive gold revaluation by the US, the creation of a treasury-issued gold-backed digital token, or a formal strategic Bitcoin reserve, remain highly theoretical fringe ideas, not actual policy. Still, this hypothetical scenario illustrates a profound shift in what economic warfare could look like. It moves beyond simple taxes and into a multi-domain conflict targeting the very architecture of a rival's financial system. Whether such a plan is ever plausible, let alone attempted, remains the stuff of speculation. But it forces us to ask a critical question. As the competition between the US and China evolves, are we entering an era where economic warfare could become as devastating as military conflict?